Okay, this is going to be a homework walkthrough for 11-1. This is spring 2024 semester. So my previous video, they added a question for last semester that I didn't catch. So I'm going to re-record this with that added question. Okay, Royal Lawn Care Company produces and sells two packaged products, Weed Ban and Green Grow. Revenue and cost information relating to the products follow, and they give us the selling price per unit for each one. Oh, whoops, let's put a period in there. So I'm just copying down the information from this chart so that I can reference these numbers. Okay, so there's my information, selling variable and traceable fixed. Traceable fixed means this cost can be traced directly back to this product line, and it is a fixed expense and it doesn't have anything to do with the other product line. So that's why it's called traceable fixed. Okay, last year the company produced and sold 37,500 units of Weed Ban and 16,000 units of Green Grow. And just as a reminder, you will probably have different numbers than I have, so do your own math. Its annual common fixed expenses are $102,000. So common fixed expenses are expenses that cannot be directly traced back to one product, but both products benefit from this expense. So that's why they are common fixed expenses. So they want us to fill out a contribution format income statement segmented by product lines. So for this, it's going to be sales minus variable expenses equals contribution margin minus traceable fixed expenses equals product line segment margin. So down to there, we're going to be working in the product lines before we get to total company. Then the common fixed expenses not traceable to the products go in the total company, and then we'll be to net operating income. Okay, so to get Weed Ban sales, it's going to be the selling price per unit for Weed Ban times the number of units for Weed Ban. I'm going to go ahead and anchor that cell so that I can drag it down to the variable. So just so you can see, by anchoring this cell, it didn't move when I drag it down, but it did move the blue box down to being the variable expenses times the units. Okay, and then in Green Grow, same thing, selling price per unit times Green Grow's number of units. Anchor that. And then do the variable expense per unit times the number of units for Green Grow. So sales minus variable equals contribution margin, which I'm sure the book did this for you. And I'm just going to drag that formula both directions so that I get that same sales minus variable. In this column, for the total company, it will be the Weed Ban sales plus the Green Grow sales. And same with the variable. It will be those two added together. I could add these together, but I like to move up and down whenever I can in the column. And so that's why I kept the sales minus the variable equals that. Okay, traceable fixed expense for Weed Ban was given in the chart. And traceable for Green Grow was also given in the chart. So then it's going to be the contribution margin minus the traceable fixed equals the product line segment margin. I'm going to drag that both directions. If I copy this formula and paste it here, it's going to shift those cells down in relation to where I have the formula. So those two added together equal the total traceable fixed for the company. Then again, contribution margin minus traceable equals the product line segment margin. So that's all we need in the product lines. Now we have the common fixed expenses, which was given in the paragraph. So then we'll take the product line segment margin total minus the common fixed expenses equals the net operating income for the company. And that is everything that is required for question 1. Okay, question 2. Rayner, Harris & Chan is a consulting firm that specializes in information systems for medical and dental clinics. The firm has 2 offices, one in Chicago and one in Minneapolis. The firm classifies the direct cost of consulting jobs as variable costs, and a contribution format segmented income statement for the company's most recent year is given. So they give us total company, Chicago, and Minneapolis, and I have just copied all of that information straight down. They also give us the ratios, right? The variable expense ratio for total company, for the Chicago office and for Minneapolis office. So again, I just copied all that straight down into here. So required 1, sorry. They want us to compute the company-wide break-even point in dollar sales. So if you'll remember, break-even point in dollar sales is the fixed expenses divided by the contribution margin ratio. So in required 1A, they want company-wide. So if you'll recall, in company-wide, there is 2 categories of fixed expenses. There's traceable and there's common. So I need to take the traceable total plus the common to get my total fixed expenses for the company. Then that will be divided by the contribution margin ratio for the total company. Don't grab one of these others because right now we're just dealing with company-wide. So that gets me to the break-even point in dollar sales. Now, I'm going to fix my view. Now, required 1B, they want the break-even point for the Chicago office and for the Minneapolis office individually. So again, it's going to be the fixed expenses divided by the contribution margin ratio. But in this instance, we're just going to look at Chicago office. So we just take into account the traceable fixed and divide that by the contribution margin ratio for the Chicago office. And then the same with Minneapolis, we'll take the traceable fixed to Minneapolis divided by the contribution margin ratio for Minneapolis. And that gets us to the break-even point in dollars for those individual offices. So the required 1C, they want to know, is the company-wide break-even point greater than, less than, or equal to the sum of the Chicago and Minneapolis break-even points? So you just have to add together those 2 answers from required 1B and then compare it to the answer from required 1A. So in my case, it is greater than. Okay. Question 3. It's the same company information. So here's that information that they gave me. And they want to know by how much would the company's net operating income increase if Minneapolis increases its sales by $75,750 per year. Assume no change in cost behavior patterns. So that's important because what I'm about to do only works if all that changes is you increase sales. So selling price didn't increase, variable expenses didn't increase, fixed expenses didn't change. All that changed was we sold more. So I can take that increase in sales, 75,750, and multiply it by that office's, so Minneapolis, contribution margin ratio. So the reason this works by taking the increase in sales and timesing it by the contribution margin ratio for that office is because all the expenses are already covered. So anything added to contribution margin gets added directly to our profit or our net operating income. So because I know that contribution margin ratio for Minneapolis, I know that 40% of this increase in sales is contribution margin. And that because my expenses are all covered, that means my net operating income is going to increase by that amount. Okay. Question 4. This is the one they added. So we're the same company still. Now we're going to assume that the sales in Chicago increase by 50,500. So the sales in Minneapolis remain unchanged. Assume no change in fixed costs. So I need to prepare a new segmented income statement for the company. So Minneapolis remained unchanged. So I'm going to copy and paste Minneapolis. Now Chicago, all that changed was that we sold more. So my ratios stay the same because none of the costs changed. And that was just for Chicago. So I need to take the original sales and add the increase with Chicago. Because I know that my variable expense ratio is 30% of sales, I can then find 30% times the new amount of sales to get my new amount of variable expenses. I can take this sales minus variable equals my new contribution margin, and my traceable fixed expense, that stayed the same. So then this contribution margin minus my traceable fixed gives me my new office segment margin. I know my common fixed expenses stayed the same, but I'm going to take Chicago's new sales plus Minneapolis sales, and then I'm going to take the variable plus the variable. Okay, so I know sales is always 100%. I need to figure out my new variable expense ratio for the total company. So I'm going to divide that by total sales. And they ask you to round these percents to 1 decimal place. So that's why I've got them 1 decimal place. So if I take my new total company sales minus my variable, I get my new contribution margin. So I can take contribution margin divided by total sales and get my new contribution margin ratio. See, it changed just a little bit. My traceable fix should still be the same, but I'm going to add that plus that. My ratio then is going to be my total traceable divided by my new sales. So notice that changed just a little bit right there. Office segment margin would be contribution margin minus traceable fixed. Again, I'm going to take office segment margin divided by my new sales, and that gets me my new office segment margin ratio. Common fixed expenses are the same, but I'm going to get my new ratio by dividing that by total sales. And then my net operating income would be office segment margin minus common fixed expenses. And then I'm going to take that and divide that by total sales to get its new ratio. So some of these the book added up for you or calculated for you, but dividing all of these individual numbers by total sales gets you the ratio. All right, question 5. Again, we're the same company, but now they've given us more information about the Minneapolis market. They've given us the Minneapolis divided by into medical and dental. So the company would like to initiate an intensive advertising campaign in one of the 2 market segments during the next month. The campaign would cost $5,050. So my advertising is going to increase $5,050. Marketing studies indicate that such a campaign would increase sales in the medical market by 40,400 and increase, or so depending on which market we apply that advertising campaign to, or it would increase sales in the dental market by 35,350. Okay, so they want to know how much would the company's profit increase or decrease if it implemented the advertising campaign in the medical market. So okay, so in the medical market, it said it would increase sales. So medical plus that 40,400, they said it would increase. And I know this is 100%. This is 36%. So, or not 36, holy cow, 64, 64%. So those 2 ratios stay the same. And actually, the contribution margin is also 36%. So down to there, it stays the same. So I can figure out my new variable expenses by taking the variable expense ratio times the new total sales. And then I can subtract sales minus variable equals contribution margin. Now, traceable fixed. This is where we add that advertising cost. If we're going to do it in the medical, it would be the traceable fixed from before plus the increase in advertising cost. So that obviously is going to change that ratio. So we need to take the new expense divided by the new sales. And so that changed to 7%. And then my market segment margin would be the contribution margin minus the traceable fixed. That divided by total sales equals my new ratio. Okay, so they want to know how much would the company's profit increase or decrease if implemented the advertising campaign in the medical market. So I have to subtract. So there's my market segment margin minus my previous market segment margin. So it increased by 9,000. And now they want me to figure out the same thing only with the dental. Right, so required, let's see, required to how much would the company's profit increase or decrease if it implemented the advertising campaign in the dental market. So I'm going to do all of those same calculations, only using the information they gave me about the change in the dental market. So it told me that the dental market would increase sales by that much plus the original sales And again, this is 100% always. And so those three ratios stay the same. I'm going to take my variable expense ratio times my new sales. So I'm going to take sales minus variable equals contribution margin. Okay, so at this point, the traceable fixed, they want us to try out if we add the advertising increase to the dental office, new ratio for that one. And then we're going to take the contribution margin minus the new traceable fixed. Okay, so what did it increase or decrease? I need to take my new market segment margin, whoops, minus my previous market segment margin, and that gets an increase of 11,918. Okay, so now the question is, should we apply, which one should we apply the advertising campaign to? Which one should we focus on? Well, it's going to be the one that makes more money. So in my problem, it's the dental. All right, question 6. Kristen Liu purchased a used automobile for $25,950 at the beginning of last year and incurred the following operating costs. So I'm going to bring those down. Okay, so it gave me depreciation, insurance, rent, tax and licensing, and variable operating costs. The variable operating costs consist of gasoline, oil, tires, maintenance, and repairs. Kristen estimates that her current rate of usage, the car will have 0 resale value in 5 years. So the annual straight line depreciation is 5,190. And they simply do that because there is no salvage value by taking the cost of the vehicle divided by the useful years of life. And that's where they come up with the 5,190. And you're going to want to remember how to calculate straight line depreciation. And that is by taking the original cost minus any salvage value, which in this case was 0, and divide by the useful years of life. And that gets you straight line depreciation. The car is kept in a garage for a monthly fee. So required. Kristen drove the car 20,000 miles last year. Compute the average cost per mile of owning and operating the car. Round your answers to 2 decimal places. Okay, so the average fixed cost per mile. So I guess we need to look up here which ones of these are fixed and which ones are variable. Depreciation is fixed. Insurance is fixed. Rent, that's fixed. And tax and licenses, that is also fixed. So that just leaves one variable cost. So to figure out the average fixed cost per mile, I would take and add up the first 4 costs and then divide that by the number of miles she drove. So my average fixed cost per mile is 50 cents. Obviously, if the number of miles changes, this answer is going to change. The variable operating cost per mile, there is only one variable cost, and it's the 8 cents in mine. And I believe the book adds this up for you to get the average cost per mile. It's the fixed plus the variable. Okay, question 2. Kristen is unsure about whether she should use her own car or rent a car to go on an extended cross-country trip for 2 weeks during spring break. What costs above are relevant in this decision? So relevant costs would be costs that are different depending on what she chooses, whether she drives her own car or if she rents a car. It's going to be a cost that is different between the two choices. Those are relevant costs. So, variable operating costs. So obviously, if she drives her own car, then gas and oil and all of that will change. So that one is relevant. Depreciation, that is a fixed sunk expense. So that is not going to change whether she drives her own car or she rents a car. Taxes and licensing, she'll still have to pay that regardless of whether she drives her car on this trip or not. Um, licensing, same thing. She still has to pay that whether she drives her car on this trip or not. And insurance costs, same thing. The others, I don't know why they didn't include rent down here, but garage rent, she's still gonna have to pay rent on the garage too if they had included that as one of these costs. Um, that is not relevant. So the only relevant cost from above is that variable cost, whether or not she drives her car on this trip. And that's it.